Well, let's get back to the broader markets now and take a deeper look at where things stand with just a few trading sessions left in the year. Joining us for that is Ken Kencel, President and CEO of Churchill Asset Management, which has more than $46 billion under management and a very active lender in 2023. You think that this is a golden age for private credit. What do investors in this space need to know?
Well, look, I think we've seen a tremendous amount of growth in the private credit space, certainly over the last 2 or 3 years. And I think that it's increasingly individual investors, their advisors are looking at the traditional 60-40 model and saying there should be room for long-term investments, alternatives, private credit. And that has fueled a tremendous amount of growth in the industry.
Even for retail investors?
Even for retail investors.
So there's a democratization of private credit, you think, underway?
I think there is, and it's interesting. You know, if you look back over the last 10 years, I would say the theme has really been the institutionalization of private credit. Large-scale pension funds, asset managers, sovereign wealth funds adopting private credit, allocating to the space. And I think the next 10 years are going to be about the democratization of private credit, individual investors, huge market opportunity.
Meanwhile, credit is very tight right now. What are you seeing in terms of the quality of the borrowers and the defaults coming down?
Sure. So interestingly, a couple of things I'd say today in private credit. One is the quality of the companies we're seeing has actually been quite good. If you think about it, you're not typically going to see the more challenged businesses raising capital today. They're going to be struggling to find financing and capital. But higher quality businesses that are growing, companies that are looking for capital to expand operations in the U.S. and internationally, they are seeing tremendous growth and opportunity, and we're seeing tremendous deal flow. The other thing I would say is that with the tremendous expansion of private credit, larger companies as well are accessing the private credit market. So it's a good time to be a direct lender.
Isn't there a private credit ETF? I'm just looking that up. I just heard about it.
Is there a private?
I think there is.
Well, there are certainly BDCs that are traded. There are Ares, right, and publicly traded BDCs. There are some funds that have been raised, primarily closed-end funds that track private credit. So the Cliffwater Index, Cliffwater has a private credit index fund that invests in private credit managers. Yes.
I think that's the one I'm thinking.
But yeah, one question I have: if the next iteration of private credit is democratization, doesn't that kind of eat at the heart of the entire business model, which is to say, private credit has these, longer duration investors, therefore they're able to make loans that the regulated banking system can't because their funding source is depositors. So if you introduce more retail as a funding source, do you bring in more regulation and therefore kind of eat into the overall advantages that this business model has had?
So today, private credit is still probably 70 to 80% institutional overall. But I think when you look at the growth trajectory and you look at the amount of capital that is sitting in the retail space that is generally underallocated to alternatives and certainly to private credit, $180 trillion, generally underallocated. If you talk to most managers, they're allocated 5 to 10% to alternatives. So there's a tremendous amount of growth there. I think the question becomes, what is the underlying structure for the vehicle, right? If the structure's right, then I think it can accommodate growth and can accommodate the illiquid nature of private credit. But that's where I think education is important. Investors need to understand that when they invest in private credit, it's generally not going to be as liquid as a stock or a bond, right? So education is a big part of that.
So Ken, I know Churchill typically focuses on non-cyclical industries. Going into 2024, what industries do you like? Where do you see opportunity?
We like software a lot. We have for a long time now. We like business services, particularly services that are really embedded in a company's operations. So long-term relationships, business services. We like healthcare, but generally stay away from healthcare reimbursement risk. So, particularly with prices increasing, overall inflation, it's been difficult for healthcare providers to pass those costs on. So generally away from reimbursement, but healthcare services we like a lot too.